In the world of commodities, one metal stands out as a true cornerstone of global economic growth: copper. With its versatility and indispensable role in countless industries, copper has earned its reputation as Dr. Copper, a trusted barometer of economic health. Join me as we explore why copper is poised to become the best performing metal over the next few years. Recently, there has been persistent speculation amongst prominent finance professionals about the impending bull market in copper. However, copper has barely nudged in price since COVID and is currently sitting below its high set in 2021. In today's video, I'll give 6 reasons why I think the time is now for copper to rise and why it could be the best performing metal of 2024. These reasons are: economic growth forecasts are understated, renewable energy capital expenditure or green capex is set to rise, fiscal and monetary policy is bullish for copper, China's economic cycle has likely bottomed out, copper supply is increasingly coming under geopolitical risk, not enough new mines are coming online, and as a bonus I'll share my strategy to profit from the rise in copper. Before we begin, most of you are not subscribed, so please hit that like and subscribe button to get instant updates when I post videos. And also, I'm not a financial advisor, so take all my content with a grain of salt and seek professional financial advice if you need to. On to the first point. If there is one metal that can describe the state of the economy, it is copper. Copper is intrinsically tied to the economy since it's a key ingredient in crucial sectors such as construction, power generation, electronics, transportation, and manufacturing. Without copper, the modern world would cease to exist. The IMF is forecasting continued worldwide GDP growth through to 2030, which means copper demand should increase in tandem. In fact, I would argue that this forecast is understating the impact of 3 economic tailwinds currently in action: the rise of AI, the rise of blockchain technology, and finally, fiscal and monetary policy combining to stimulate the economy, which I'll get into in the next section. The question then becomes, have all these economic tailwinds been priced into the copper price? Since copper is a commodity that trades off supply and demand and not expectations, like equities, I would argue that no, none of these factors have been priced in. But let's go through these economic tailwinds in more detail. We'll begin with AI and the boost of productivity it may bring. An increase in productivity is likely to bring about an increase in economic growth, all else being equal. According to Goldman Sachs, AI could eventually boost GDP by 7%, mainly through productivity gains. When it comes to the blockchain, PwC reckons it could boost global GDP by $1.76 trillion from 2020 to 2030, mainly through the tracking and tracing of products and services. Let's now talk about the third factor on its own, and that is fiscal and monetary policy and its impact on copper demand. Fiscal policy is conducted by the government and monetary policy is conducted by the Federal Reserve. In terms of monetary policy, the biggest policy lever that the Federal Reserve can pull is changing the federal funds rate. As of March 2024, the Fed is expecting to make 3 cuts to the federal funds rate in 2024, which will lower the cost of capital and make it cheaper for capital investments to occur, a lot of which will require copper. That's the monetary side, but what about the fiscal? We have the US Chips and Science Act of 2022, which aims to bring chip manufacturing and supply chains to the US. This is to encourage local jobs and boost national security. This is going to be good for copper demand since building manufacturing capacity is heavily copper intensive. President Biden in the same year also passed the Inflation Reduction Act, or IRA, which was created to incentivize investment in renewable energy and low emission fuels. Goldman Sachs reckons $1.2 trillion will be spent up to 2032 by the government alone. This leads me directly to the next section, which is investment in green energy. According to the International Energy Agency, net zero in carbon emissions is required by 2050 in order to prevent global temperatures reaching 1.5 degrees above pre-industrial levels. Here's a diagram showing different investments in green capex that need to be spent in order to get there. As you can see, nothing really looks surprising here, and the common denominator, as you guessed it, is copper. The same report also says coal, oil and gas demand would fall by 90, 75 and 50% respectively by 2050 to be replaced by solar, which would meet 20% of global energy demand. As we know, solar is copper intensive. One drawback to solar, however, is that it is intermittent. During nighttime, it doesn't create power. So the power needs to be stored in huge batteries, which is currently economically unfeasible. In order to solve this intermittency problem, the world still requires some form of stable power source, and that usually comes from fossil fuels such as coal, which means we need both green and brown energy sources. Even though brown energy sources such as coal are not as copper intensive as green energy sources, they still use substantial amounts of copper in their construction. One of the world's foremost commodities experts, Jeff Curry, reckons there needs to be an increase of investment by $20 trillion to get to net zero by 2050. He also says that this supercycle will be underpinned by demand from EVs and renewable energy. Here's an audio clip of him talking about his bullish views on copper.
And when we think about metals, think about all that EV demand. That's going to be your big CapEx boom. Like what we think about, what was China? China was a metals demand boom to go construct all those cities. This one's going to be a metals demand boom to go construct EVs and decarbonization and green technologies. Very similar to what China was. In fact, we argue that the demand for green CapEx this decade is bigger than the demand for CapEx during the China boom years of the 2000s. And then the decade after that, it's 2 times China. So I really push back against there's not demand for commodities. It's going to be an enormous amount of demand for commodities going forward.
Here's another interview where he talks about how tight the supply-demand balance is in copper.
But is there like a particular market, region, or technology or infrastructure that you see as, okay, this is an area where there's a bottleneck where we really need some investment to move the needle?
Copper. Copper, no, there's no ifs, ands, or buts. And it baffles me why it won't move. I mean, what are you going to have to do? Just take the inventory to absolute zero on the planet, no more excess capacity. I mean, Chinese are considering it. You cannot decarbonize. You cannot electrify the world without copper, and we simply don't have enough of it. I really believe this story, and I think it's really essential to it.
Peter Oppenheimer from Goldman Sachs says having renewable energy infrastructure means that power grids must be digitized, which will require, you guessed it, copper. As such, green demand will rise significantly over the next few years if green capex continues in earnest. Moving on to China. China's economy has been in the headlines recently, but for all the wrong reasons. Crashing housing industry, deflation, weak consumer sentiment and spending, etc. However, the facts are that China's GDP is still rising, if the government statistics are to be believed, and furthermore, Chinese manufacturing production is on the rise after declining for a few years, which usually signals the bottom of the economic cycle. Real estate has been a drag for a few years, but it doesn't seem to be getting worse. Colin Hamilton, a commodities analyst from BMO, talked about China in a recent presentation. The chart on the left shows continued weakness in the real estate sector. When we go to the chart on the right, note the increase in industrial loans relative to private loans, which are usually housing related. This may be linked to high investment in manufacturing, and copper should be a key beneficiary of this. This may also offset the housing downturn to some extent going forward. These data points indicate that China's economy may be in the process of recovery, which will be good for copper demand going forward since China is a huge consumer of copper. One of the underappreciated facts of copper is that a lot of it comes from geopolitically risky jurisdictions. Not only that, but combined with the rise of resource nationalism and environmental concerns means that a lot of the world's copper supply is under a shroud of political uncertainty. Countries like the DRC, Chile and Peru dominate global production of copper. The DRC is one of the most politically precarious nations in the world, but what about Chile? You may think that the South American country is stable because it is an OECD country, but data suggests otherwise. Chile's political rating has been steadily declining over the past few decades, and lately there has been popular unrest due to cost of living pressures and corruption. Since 2022, a socialist president has been in charge of Chile, and last year he announced the nationalization of the country's lithium assets. Furthermore, he's also threatened to raise royalties on mining companies, which would make it more costly to mine. Not only will these developments scare current investors in Chile's mining projects, but it may deter future investment in all commodities including copper. Over in Panama, a mine owned by Canadian company First Quantum Minerals was suspended last year due to environmental concerns. The mine has currently been shut down, and it's estimated that approximately 1% of global copper production has been removed. These factors increase the cost of copper mining globally, which is likely to slow the development of new mines. Although copper demand is set to rise over the next few years, it appears the supply coming from mines will not be enough to match it. Jeff Curry says the combination of a collapse in prices, ultra-low rates, return on capital, coupled with the growth in ESG policies, has contributed to underinvestment in new copper mines over the past 10 years. Goldman Sachs investment research reckons there will be a significant shortfall in supply in 2025. This chart from S&P Global depicts reasons for the supply crunch. Notice how the investment in copper mines has been steadily declining over the past 10 years. Most of this investment was in existing mines with declining grades. The same report actually reckons there will be a small copper surplus until 2026, but due to the reasons I've outlined previously that may boost demand going forward, this surplus may very well turn into a deficit. Mines are also getting deeper and lower grade and also older, meaning aging infrastructure. All of these factors entail a higher cost of mining copper, which will likely deter mining projects on the margin from being approved. This will serve to limit supply. Now that I've gone over the reasons for copper's rise in price, let me share my strategy for how I'm going to profit from such a move. In any commodities bull market, you can trade it three ways: physical commodity, the miners, or the futures market. You can't trade physical copper as a speculative play, unlike physical gold, so I will stick to buying miners and going long futures. Why futures, you may ask? Well, it offers a pure play on the copper price and also provides a little bit of leverage. I won't cover copper futures in this video, but I'll go over my two favorite copper stocks. When it comes to mining stocks, I believe that the companies with the best assets and the best balance sheets are likely to produce the highest risk-adjusted returns. Sure, you get more leverage with the small and mid-cap miners, but they usually have more risk in the sense that their deposits are typically not world-class, their management usually has less experience, their mines have high running costs, they're saddled with a lot of debt, or a combination of all of these factors. You might not get the highest returns from quality large cap miners, but it's almost guaranteed you will see upside if the underlying commodity does really well, which I suspect copper will. With that said, my favorite copper mining stocks are Zijin Mining and Teck Mining. Zijin Mining is a top tier copper gold producer based in China. Not only does it control the biggest copper deposits within the country, but it also has stakes in huge copper mines around the world, like the Kamoa-Kakula mine in the DRC and the Cukaru mine in Serbia. It also owns several large copper refineries in China, so it is somewhat of a vertically integrated player. My second stock is Teck Mining. Teck is a diversified Canadian miner focused on copper. It also mines coal, but this will be divested from the company soon, turning Teck into a pure play copper miner. Teck has some world-class copper assets scattered all throughout North and South America. These are the two copper stocks that I own, and I believe that's all I need in terms of copper equity exposure for now. I don't want to dilute my holdings by owning any more miners, otherwise I might as well buy a copper ETF like the Global X Copper Miner ETF, ticker symbol COPX. None of this is financial advice, so please undertake your own due diligence before investing in any of these companies. With that said, we're at the end of the video. Let me know in the comments below where you think copper will be headed by the end of the year, and please hit the like and subscribe button to get more financial videos like this one. Thanks for watching and see you next time.